April 5th, 1933. Executive Order 6102. Every American citizen ordered to surrender their gold to the Federal Reserve. The penalty? $10,000 or 10 years in prison. The government paid $20.67 per ounce. 9 months later, they revalued that same gold to $35. The profit went to the Treasury. The loss went to you. It is April 6th, 1933. It is 7:14 in the morning. Frederick Barber Campbell, 62, attorney at law, is sitting in the reading room of the Metropolitan Club on East 60th Street in Manhattan. He is a Harvard Law graduate, class of 1894. He is a partner at the firm of Campbell and Whip, with offices at 20 Exchange Place, right in the heart of Wall Street. He serves as a director for several British and American insurance companies. He belongs to the Union Club, the Century Club, and the Metropolitan Club, where he lives. And as of yesterday morning, he is technically a criminal. He picks up the New York Times. The headline reads, "Hoarding of Gold." The executive order issued by the president yesterday amplifies and particularizes his earlier warnings against hoarding. The article explains that on March 6th, taking advantage of a wartime statute that had not been repealed, Roosevelt issued Presidential Proclamation 2039 that forbade the hoarding of gold or silver coin or bullion or currency under penalty of $10,000 fine or 10 years imprisonment or both. Campbell sets down the newspaper and thinks about what is sitting in the vault at Chase National Bank. 27 bars of gold bullion. 13 bars deposited on October 11, 1932. 14 more deposited on January 25, 1933. Each bar was cast by the United States Treasury and bears its official stamp and number. Total value at the government price of $20.67 per ounce, $135,000. He purchased every bar legally. He stored them under a written custody agreement with the bank, paying a reasonable fee for safekeeping. And as of yesterday morning, the President of the United States has declared that all of it must be surrendered to the Federal Reserve. Campbell is not the kind of man who surrenders anything. He does not know it yet, but the decision he makes over the next 5 months will result in the only criminal prosecution under Executive Order 6102 in American history. And what happens to his gold will show exactly how governments take wealth from citizens who believe they are protected by the law. My name is Ban. I have spent 6 weeks going through the National Archives records of Executive Order 6102, the full text of the Gold Reserve Act of 1934, the court filings from Campbell v. Chase National Bank, Equity number 76-307, and the Federal Reserve historical documents from 1933 and 1934. What I found is not a simple story about a president saving the economy. It is a documented, step-by-step record of how one government seized private wealth, repriced the entire monetary system, and made a $3 billion profit while citizens were paid at the old rate. I'm going to show you exactly what Frederick Barber Campbell did, what happened to the approximately 30,000 Americans who also refused to surrender their gold, and why the same legal framework that made this confiscation possible in 1933 still exists, fully functional, in 2026. If you find this useful, hit subscribe, because I cover these historical patterns every single week. But first, you need to understand what Campbell understood that almost nobody around him had figured out. Roosevelt was not just collecting gold. He was about to reprice it, and anyone who surrendered at the old price was about to hand the government a 69% profit on every single ounce. Here is the background you need. On March 4, 1933, Franklin Roosevelt was inaugurated as the 32nd President of the United States. The country was in ruins. Unemployment stood at 24.9% of the total workforce. That's 12,830,000 Americans with no work. Between 1930 and 1933, approximately 9,000 of the nation's 25,000 banks had failed. Depositors had lost a combined $1.36 billion. Adjusted for inflation, that's $32 billion in today's money. Gone. The stock market had already been destroyed. The Dow Jones Industrial Average peaked at 381.17 on September 3, 1929. By July 8, 1932, it had collapsed to 41.22. That's an 89.2% decline in 34 months. It would not recover to its 1929 high until 1954, 25 years later. The fundamental problem was the gold standard. Under the Federal Reserve Act of 1913, the Fed was required to hold 40% gold backing for every Federal Reserve note in circulation. This meant the government could only print money if it had gold to back it. But by 1933, Americans had lost all trust in the banking system. They were pulling gold out of banks, out of circulation, and hoarding it at home. $1.4 billion in gold was being held privately, outside the system. The Fed literally could not expand the money supply because citizens were sitting on the backing. Roosevelt's solution was blunt and immediate. Executive Order 6102. Signed April 5, 1933, the order required all persons to deliver on or before May 1, 1933, all gold coin, gold bullion, and gold certificates to a Federal Reserve Bank or any member bank of the Federal Reserve System. The government would pay $20.67 per troy ounce, the official price that had been set by the Gold Standard Act of 1900 and held for 33 years. The exceptions were narrow. You could keep up to $100 in gold coins, roughly 5 ounces. Gold used in legitimate industry, profession, or art was exempt. Rare coins with recognized special value to collectors were exempt. Everything else went to the government. The penalty for non-compliance? A fine of up to $10,000, which in 2025 terms equals $249,000, or up to 10 years in federal prison, or both. Now here is where the pattern gets strange. What happened after the gold was collected is the part that reveals the real mechanism. On January 30, 1934, 9 months after the confiscation deadline, Roosevelt signed the Gold Reserve Act. This law did 2 critical things. First, it transferred ownership of all monetary gold in the United States to the Treasury, not just the confiscated gold from citizens, all gold, including every ounce held by the Federal Reserve itself. Second, the very next day, January 31, 1934, Roosevelt proclaimed a new official gold price to $35 per troy ounce. I call this the gold seizure mechanism, and it has 4 phases that repeat every time a government confiscates monetary metal. Phase 1 is accumulation. The government acquires gold at the existing low price. Phase 2 is legal mandate. The government passes a law requiring citizens to surrender their gold. Phase 3 is revaluation. The government raises the official price after the gold is in the government hands. Phase 4 is profit extraction. The government books the difference as revenue while citizens absorb the loss in purchasing power.
Let me run the exact numbers. A citizen who obeyed Executive Order 6102 and surrendered 100 ounces of gold on May 1, 1933, received $2,067. 9 months later, when the Gold Reserve Act set the new price, that same 100 ounces was officially worth $3,500. The government kept the difference, $1,433 per 100 ounces. That is a 69.4% markup. Applied across all the gold the Treasury accumulated, the revaluation generated close to $3 billion in profit for the government. In 2025 terms, that is approximately $82 billion. The Treasury used $2 billion of this windfall to create the Exchange Stabilization Fund, a new entity under the sole control of the Secretary of the Treasury with no congressional oversight required. The citizens who followed the law were compensated at the old price. The government that wrote the law kept the profit from the new price. That is not my interpretation. That is the documented record from the Federal Reserve History Archive and the Gold Reserve Act itself, Public Law 73-87. Now let me show you what happened to the people who refused. Frederick Barber Campbell was one of approximately 30,000 Americans who did not surrender their gold by the May 1st deadline. For 5 months, nothing happened. Then, on September 16, 1933, Campbell walked into Chase National Bank and formally demanded the return of his 27 bars of gold. The bank refused. Under the emergency banking regulations, Chase was legally required to surrender Campbell's gold to the government, not return it to its owner. The very next day, September 26, 1933, Campbell filed a lawsuit in United States District Court against Chase National Bank. The suit sought to compel the bank to deliver his gold. He argued 2 things. First, that Congress had no constitutional power to delegate its legislative authority over gold to the president. Second, that the Fifth Amendment, which prohibits the government from depriving any person of property without due process of law, protected his gold from seizure. Campbell was not the only one trying to protect his gold. A well-known numismatist named Abe Kossoff later recounted how he had arranged, on behalf of several wealthy clients, to have bags of $20 gold coins shipped to a European bank before the surrender deadline, anticipating both the order and the revaluation. It worked. The gold left the country legally. But then a Treasury agent visited Kossoff. The agent told him the government had been examining bank withdrawal records for the 6 months prior to Executive Order 6102, tracking anyone who had pulled significant gold from the banking system. Kossoff was given a fixed period to return the coins or face prosecution. He returned them. The message was clear. The government was not just collecting gold from willing citizens, it was actively hunting for gold that had been moved before the order was signed. 1 day after Campbell filed his lawsuit, September 27, 1933, a federal grand jury in Manhattan indicted him. The session lasted exactly 18 minutes. The indictment charged him with failing to register his gold holdings, which by that point were valued at $200,574.34. A second charge of actual hoarding was added. Campbell now faced 20 years in prison and a $20,000 fine. But it gets darker. Federal Judge John M. Woolsey examined the case and ruled the prosecution under Executive Order 6102 invalid. The technical reason was significant. The order had been signed by the president, but the underlying Trading with the Enemy Act required the signature of the Secretary of the Treasury. Campbell won on procedure, but he lost his gold entirely. The federal government upheld the authority to seize gold under the emergency powers, and Campbell's 27 bars were confiscated. He never recovered a single ounce. The Roosevelt administration immediately corrected the procedural flaw. Secretary of the Treasury Henry Morgenthau Jr. signed new Executive Orders 6260 and 6261, which provided for the seizure of gold and prosecution of hoarders under the correct legal signature. The Gold Reserve Act of 1934 then gave permanent legislative authority to what had begun as emergency executive action. Gold ownership would remain illegal for American citizens for 41 years, until December 31, 1974, when President Gerald Ford signed Executive Order 11825, and Congress restored the right to own gold.
And here is the part that almost nobody documents. While Campbell was fighting the government and losing, a woman named Rosa Valdez in San Antonio, Texas, came through the same period without losing a single dollar. Rosa was 49 years old, a seamstress and small landowner. She had $1,200 in 1933, which she had split 3 ways. $400 sat in a postal savings account at her local post office. $500 was invested in a 1.2-acre plot of land on the eastern edge of San Antonio, which she had purchased in 1921 for $180. $300 was in sewing equipment and supplies for her business. Executive Order 6102 did not touch any of it. Rosa held no gold coins above the $100 exemption threshold. Her postal savings account was a direct obligation of the United States government. It survived every single one of the 9,000 bank failures between 1930 and 1933. The postal savings system eventually grew to $3.4 billion by 1947, serving 4 million Americans who had lost all faith in commercial banks. Rosa's land had no seizure provision under any executive order, any act of Congress, or any emergency proclamation. The Fifth Amendment protected productive private property, and no case of seizure of debt-free productive land exists in the documented record from this period. Her sewing equipment was a productive business asset with zero confiscation risk. By 1940, her land had been rezoned for commercial use and was worth $1,800, a 260% gain on her original purchase price of $180. Her postal savings had earned 2% annually through the entire Depression, compounding quietly while 9,000 banks collapsed around her. Her sewing business generated steady income throughout the worst decade in American financial history, sustaining her family when 12 million Americans had no income at all. Now here is why I am spending so much time on 1933. The legal framework that enabled Executive Order 6102 has never been fully dismantled. In 1977, Congress did remove the president's authority to regulate gold transactions in non-emergency conditions. But Section 5B of the Trading with the Enemy Act of 1917, the precise statute that Roosevelt invoked on April 5, 1933, remains on the books. During a declared national emergency, the president retains broad authority over financial transactions, including the power to regulate or prohibit the hoarding of gold, silver, currency, or credit. And the modern equivalent should concern you even more. The Dodd-Frank Wall Street Reform Act of 2010 created what is called Orderly Liquidation Authority. This gives the FDIC the legal power to conduct a bail-in at a failing bank. What does that mean in plain language? It means deposits above the $250,000 FDIC insurance limit can be converted into equity shares of the failing bank. Your cash becomes stock in a bankrupt company. This is not theoretical. In March 2013, the government of Cyprus imposed exactly this mechanism on its citizens. Depositors at Bank of Cyprus with balances above 100,000 euros lost 47.5% of their money overnight. The banks closed for 2 full weeks. Capital controls restricting withdrawals lasted for 2 years. In 2026, gold is trading above $4,700 per ounce. Central banks worldwide are buying at record rates. The People's Bank of China extended its gold purchases for 15 consecutive months through January 2026. Gold hit an all-time high of $5,595 on January 29, 2026, before pulling back sharply, losing almost $1,200 in 2 days in the worst rout since 1983. Yet JP Morgan did not lower their forecast, they raised it. Their target is now $5,000 per ounce by year-end 2026. Goldman Sachs went higher, raising their forecast from $4,900 to $5,400 per ounce, citing continued central bank diversification away from the dollar. Meanwhile, U.S. national debt has reached $38.86 trillion as of March 2026. The debt-to-GDP ratio stands at 125%, the highest since the post-COVID spike. The Congressional Budget Office projects federal debt held by the public will rise from 101% of GDP in 2026 to 120% by 2036, surpassing the World War II record. Annual interest payments on the national debt exceeded $1 trillion for the first time in 2025. The government is paying more in interest than it spends on national defense. When governments accumulate gold at record pace while their citizens hold paper currency, the historical pattern from 1933 is running again. Every major gold revaluation in history was preceded by government accumulation and followed by currency devaluation. So what does the 1933 playbook look like translated into 2026? Here is what Rosa Valdez did then. Here is the modern equivalent of each move. Rosa's first move was government-backed savings held outside the commercial banking system. The 2026 version is a Treasury direct account. You purchase Treasury bills, I-bonds up to $10,000 per year, and short-term government securities directly from the United States Treasury at treasurydirect.gov. Your money never sits on a commercial bank's balance sheet. It is a direct obligation of the United States Treasury. You can open an account in 15 minutes. I want to be clear here. I am showing you what the historical record documents. This is what happened in 1933, and these are the legal structures that exist in 2026. Whether you act on any of this is entirely your decision. Rosa's second move was productive land held debt-free. The 2026 equivalent is farmland exposure through a publicly traded REIT like Farmland Partners, ticker symbol FPI, or Gladstone Land Corporation, ticker symbol LAND, which has paid monthly dividends including through the 2008 crash and the 2020 crash. The USDA has documented farmland appreciation in 49 of the last 50 years. The single down year was 1986. No case exists in American legal history of the government seizing debt-free productive farmland from its owner without full compensation under the Fifth Amendment. Farmland is the Rosa Valdez asset.
Rosa's third move was investing in productive skills and business equipment that no government order can confiscate. In 2026, the equivalent is licensed portable professional skills. According to the Bureau of Labor Statistics, a licensed electrician earns a median salary of $61,590 with 11% decade growth. A cybersecurity professional holding a CompTIA Security Plus or CISSP certification earns a median of $112,000 with 32% projected decade growth. During the Great Depression, skilled tradespeople could barter services for food, shelter, and supplies. A plumber had value in any economy. A stockbroker did not. A skill cannot be confiscated, devalued, or frozen in a bank. Here's the one number I want you to watch. The FDIC publishes a problem bank list every quarter. You can find it at fdic.gov. It is free and public. When that list exceeds 50 institutions, it has historically preceded every major banking crisis in the last 40 years. The list crossed 50 before the savings and loan crisis of 1989. It crossed 50 before the financial crisis of 2008. As of the most recent quarter, you can check the number yourself. That is your early warning signal. Not the news, not the stock market, the FDIC problem bank list. Frederick Barber Campbell fought the United States government for years. He was a Harvard-trained attorney. He lived at the Metropolitan Club. He had the legal expertise, the financial resources, and the constitutional arguments to challenge Executive Order 6102 all the way to a federal judge. And he won. Judge Woolsey ruled the prosecution invalid. But Campbell still lost every bar of gold, all 27 of them, confiscated. The government fixed the procedural error within weeks, issued new orders under the correct signature, passed the Gold Reserve Act, and made the seizure permanent. Then they revalued the gold and booked a $3 billion profit. Rosa Valdez never hired a lawyer. She never filed a lawsuit. She never appeared before a federal judge. She was a seamstress in San Antonio with $1,200 to her name. She did not need to fight the government because she held assets that the government had no legal mechanism to take. Her postal savings survived 9,000 bank failures. Her land appreciated 260% over 7 years. Her skills fed her family through the worst economic decade in American history. She did not win a legal battle. She made the legal battle irrelevant. The date is different. The pattern is identical. Governments do not announce confiscation in advance. They declare emergencies. They invoke wartime statutes. They redefine what citizens are permitted to own. And the people who structure their assets outside the system's reach do not need to fight, because the fight never reaches them. You are not Frederick Barber Campbell, but you are standing at the same kind of moment.
Gold is at all-time highs. Government debt is at 125% of GDP. Central banks are accumulating gold at record pace, while their populations hold depreciating paper. The legal tools for confiscation, bail-in, and emergency asset seizure exist today in the United States, the European Union, the United Kingdom, Canada, Australia, and Japan. The question is not whether it could happen again. The question is whether your assets are structured like Campbell's or like Rosa's. This is BAN. The record is clear.